Welcome back, learners, to the course on Essentials of Financial Management, Module 2, Lecture 8 on Importance of Capital Structure. If you remember, in the previous lecture, we discussed about the concept of undercapitalization, and we also discussed few questions on the undercapitalization, overcapitalization, fair capitalization. In lecture 8, that is on importance of capital structure, we are going to discuss about what is capital structure and how it is different from the concept of financial structure, what are the importance of capital structure, the patterns of capital structure, what are the essential features of a sound capital mix, and finally the concept of financial distress and capital structure. So, let us start. Capitalization. So, what is capitalization? We have already discussed this concept slightly in the previous lecture. So, let us continue. So, capitalization refers to the total amount of funds a company raises to finance its operations and growth. It represents the overall size of financial resources available to the company. So, when you talk about capitalization, it talks about the total funds that the company raises to finance its operations and growth, whether it raises it through equity capital, through debt capital, through preference share capital. It represents the overall size of financial resources available to the company, right. So, what are its components? The first one is share capital, funds from shareholders. It can be from common stocks, it can be through preference shares, or the retained earnings, that is, it is retaining year after year, that is the plowing back of profits. Or it can be debt capital, that is the borrowed funds. You can issue debentures, you can issue bonds, you can get money from loans, right. What is the focus of this? Capitalization focuses on the scale of resources, not their specific mix. So, I think if you remember, if a firm requires rupees 100 lakhs and it has different options to raise this 100 lakhs, let us say 40 lakhs from debt, 40 lakhs from equity and 20 lakhs from preference shares. So, we are not much bothered about this composition, we are only bothered about this total amount. This total 100 lakhs is the capitalization. We are not getting into the specific mix or the proportion. When we are talking about this specific mix and proportion, this 40%, 40% and 20%, this is what your capital structure is about, right. So, now let us talk about capital structure. Capital structure of a company refers to the composition or makeup of its capitalization, and it includes all long term sources, that is loans, reserves, shares and bonds. So, we have understood the concept of capitalization, and capital structure is about the makeup of the capitalization, the proportionate amount of various securities in that capitalization, right. So, we have already discussed, out of 100 lakhs, if we issue if we raise money of 40 lakhs through equity shares, 40 lakhs through debt and remaining 20 lakhs through preference shares, this composition, this breakup, this mix of 40%, 40%, 20% is what is capital structure. Capital structure focuses on composition or proportion of different sources of funds that makes up company capitalization. We have already discussed this. Components, it is a mix of debt and equity used to finance a company's assets and operations. Equity gives the ownership rights to the shareholders, whereas debenture holders are the creditors for the company. Capital structure focuses on the mix of debt and equity and how it affects the company's risk and return. The capital structure can have an impact on the level of risk the company has. Higher levels of debt increases the financial risk, whereas if the company has higher levels of equity, so somehow the control is getting diluted. So, this has an impact on the risk. If a company needs 100 lakhs, this we have already discussed, so we are not going into this. So, let us go to the next topic, that is the financial structure. Financial structure is a broader term that encompasses all sources of funds of a company, including long term and short term financing. When we talk about capital structure, we are only emphasizing on the long term sources of funds, debentures, bonds, equity, preference shares. But when we are talking about the financial structure, it is a much broader concept, and it talks about the all sources of funds, whether the long term, it also includes the short term sources of financing as well. So, here is the financial structure. It includes all items on the liability side of a company's balance sheet. So, equity, long term debt, this we already had when we are talking about the capital structure, right? Apart from this, we also have short term debt, whether it can be a loan which is of less than a year, or we can have some other liability like the tax liability which you have to pay within 1 year. So, these all things will be included as a part of the financial structure, much broader concept. It focuses, financial structure provides a complete picture of how a company finances its assets and operations, not only focusing on the long term liabilities, but also the short term liabilities. Now, a company's financial structure would include not only 40 lakhs through debentures, 40 lakhs through equity, and the remaining 20 lakhs through preference shares, but also any short term loans it uses apart from these sources. So, that is what financial structure is. So, now I think we can understand this concept with a problem, or we can say an example, to have a better understanding of the concepts. So, first let us understand capitalization, then capital structure, then financial structure. So, here you have all the liabilities of a company. So, you have the equity share, preference share, long term loans and debentures, you have retained earnings, you have capital surplus, you have current liabilities. So, the total liabilities of a company here is given as 25 lakhs, right. Now, first let us understand what is capitalization. It refers to the total amount of securities issued by a company. So, we are not making a distinction between the long term or the short term securities. If you see these 1, 2, 3, 4, 5, that upper 5, that is equity share capital, preference share capital, long term loans and debentures, retained earnings, capital surplus, these 5 are long term sources, whereas the last one, that is the current liability, is a short term source. But we are taking all these into considerations when we talk about the concept of capitalization. So, the capitalization of the company is 25 lakhs, not any distinction between the long term and the short term. But when we talk about the capital structure, here we only focus on the long term sources of funds, and we do not take into consideration the short term liabilities. So, initially we take into consideration the equity share capital, the preference share capital, and the long term debentures and their respective proportions. So, if we see the equity share capital is of 10 lakhs and it has a 58.22% of the total capital, and then 5 lakhs of preference shares, which is 29.41, 2 lakhs of long term loans, which contributes to 11.77. So, this is one view, and some authors say that apart from these long term sources, you should also include the retained earnings and capital surplus as far as the capital structure is concerned, right. So, if we take that opinion into consideration, so we will add these two. Now, the mix or the proportion changes slightly. Now, the equity share capital consists of 42.55%, preference share capital consists of 21.28%, long term loans and debentures, they consist of 8.51%, retained earnings 25.53%, and capital surplus as 2.13. So, their contribution goes down because of the inclusion of these two sources also. Finally, the financial structure, it refers to all the financial resources, whether we are talking about short term as well as long term. In capital structure, we did not include the short term, that is the current liability, but in financial structure, we will include the current liability also. So, it again talks about the proportion or the mix. So, here the equity share capital consists of 40%, preference share capital 20%, long term loans 8%, retained earnings 24%, capital surplus 2%, and we have included the current liability, that is 6%. Entire this consists of 100%, right. Importance of capital structure. So, what is the importance of capital structure? Maximizing shareholder value. So, the proportion of debt and equity plays a significant role in enhancing the earnings per share. If you increase the proportion of debt in the capital structure, the earnings per share can be increased. Optimizing the cost of capital. Debt advantage. We all know that debt is a cheaper source of funding as compared to the equity share or the preference shares, because you get the benefit of tax leverage. The interest that you pay on debentures to debenture holders is considered as a tax deductible expense. So, you get that advantage. Apart from that, debt is cheaper because you see the debenture holders are not taking that much of risk because they are assured of the interest, right. So, from that perspective they are assuming lesser risk, though they get lesser return. Equity cost, as compared to debt, equity is considered as costly because equity shareholders assume more risk, right, because whether they will get dividends or not, that is not very clear. It entirely depends on the quantum of profits that the company makes and the decision of the board of directors. So, from that perspective, equity is costly and company's cost of equity also becomes higher. Finding the balance. So, when the company tries to optimize the cost of capital, it needs to strike a balance between the cost of equity, cost of debt, cost of preference shares to get a relatively lower weighted average cost of capital. Managing financial risk, debt and risk. It is true that debt is a cheaper source of funding, it reduces the overall cost of capital, but inability to make regular interest payments and the total amount at the maturity might lead to the risk of liquidation also. So, that has to be taken into consideration when a lot of debt has to be used. So, company must make sure that it strikes a balance between reduced cost and the risk that it is getting into, right, when using more of debt. Equity and stability. Equity provides stability. Equity is a costly source of finance for the company, but it does not necessitate or there is no legal obligation to make regular dividend payments, unlike the interest on debentures, which is a legal obligation for the company. So, if the company has sufficient profits, it will pay dividends, otherwise it may decide not to pay the dividends. That is why it provides stability to the company to some extent. Risk tolerance. Company must analyze the risk tolerance, how much risk they are willing to take for getting a amount of return on their investments, and accordingly they should use the extent of debt. If their risk tolerance levels are high, they can go for higher levels of debt. If their risk tolerance levels are low, they should avoid the excessive usage of debt. Ensuring financial flexibility, access to funds. So, access to funds is also important because let us say a company has taken a lot of debt. Now, what happens, all of a sudden they get a very lucrative opportunity to make investment in some projects, but they already have a very high debt equity ratio, let us say of 4:1. So, it might find it difficult to get additional debt at that point of time to tap onto that opportunities. So, access to funds and debt capacity, these two things should be taken into consideration while planning the capital structure. Investor confidence. Again, if a company uses a lot of debt, the risk to investors also increase because the financial risk of the company increases. So, investor confidence might go down if the company is highly levered or has a very high debt equity ratio. Now, let us talk about the different patterns of capital structure. So, a capital structure of a company can be of various securities. A company can issue equity shares only, it can issue a mix of equity shares and preference shares, it can be a combination of equity shares or debentures. When I say debentures, it is the creditorship securities, it can be bonds also. It can be a combination of equity shares, preference shares, debentures. So, it entirely depends on the company and the amount of control that the company wants to exercise, the amount of risk that the company wants to take, amount of return that the company wants to generate. It all depends, the capital structure entirely depends and varies from organization to organization. Now, let us understand this. This is very important. Capital structure, that is debt equity mix, cannot affect the total earnings of the firm, but it can affect the share of earnings available to equity shareholders. Now, this is very important to understand. Debt equity mix or the capital structure of a company, it cannot affect the total earnings of the firm. I am using the word cannot, but it can affect the share of earnings available to equity shareholders. How? Let us understand this with an example. Let us say there is a company and it raises rupees 1 lakh by issuing equity shares and invests the amount to generate return of rupees 30,000. So, 30,000 return is generated on an equity of how much? 1 lakh. So, there is a 30% return on equity capital, right. This is. Now, let us say the company wants to expand. So, for obviously for expansion you need much capital. So, it requires another rupees 1 lakh for expansion. As of now it has 1 lakh of equity, it requires another 1 lakh. Now, it has two options, right, to raise this additional 1 lakh. What it can do? The two options are, it can raise this additional amount by issuing, okay. Now, this 1 lakh that it wants to raise, we have to consider that it will fetch a similar rate of return on the investment, right, in both the options. What are both the options? Option A, it raises rupees 1 lakh by issuing equity shares. Option B is, it raises rupees 1 lakh by issuing debentures at the rate of 10%. So, we already taken in both the cases the rate of return is same, that is 30%. Whether it raises 1 lakh through equity and invests somewhere, it raises 30%, and whether it raises 1 lakh through debentures and invests somewhere means in the same project, it gets 30%. So, obviously, the sources from which you are raising, that is not important, because you are putting it somewhere and you are generating a return. So, whether it is raised through debentures, it is raised to equity, that 1 lakh is going to generate 30% return, that is 30,000, right. I think it is clear. Now, which option should the company choose? Whether it should choose option A, that is it should raise 1 lakh by issuing equity share, or it should choose option B, that is raise 1 lakh by issuing debentures at the rate of 10%. Now, let us understand this. So, if a company goes with option A is it uses or issues another 1 lakh through equity. So, what is the total earnings? This 30,000 is on the return on the initial 1 lakh it had, that is the 1 lakh initially, and this 30,000 is the return which it has issued now. So, 30,000 on the initial 1 lakh, 30,000 on the later one, that is the 1 lakh equity. This comes out to be 60,000 on an equity capital of 2 lakhs, right. 1 lakh it already had 1 lakh of equity, and 1 lakh equity it is raising later, on which it is getting 30,000. So, the total earnings of the company is rupees 60,000 on an equity capital of 2 lakhs, right. The company makes an earnings of 60,000 on equity capital of 2 lakhs. I think it is clear. Okay. So, what is return on equity? That is ROE. 60,000 on equity capital of 2 lakhs, that is 30%. So, it was 30% initially, again it has remained to 30% if company sticks to plan A. Now, let us say company goes with option B. What is option B? It raises additional 1 lakh by issuing debenture at the rate of 10%. So, now what will total earnings? This 30,000 is on the initial 1 lakh of equity, that is it has raised, and this 30,000 is the return it is generating on 1 lakh of debentures. So, 30,000 plus 30,000 is 60,000 the company has generated. The company will pay an interest of 10%, that is 10,000 of 1 lakhs is 10%, because it has raised through debentures. Obviously, when you raise money through debentures, you have to pay a fixed rate of interest, and we know the fixed rate of interest was taken as 10%. So, company pays 10,000. So, first need to take out this from the total earnings of the company. So, company makes an earnings of 50,000. How we got this 50,000? You take 10,000 out of 60,000, this comes out to be 50,000. So, return on equity capital is 50%. Why? Because you have 1 lakh of equity capital and the return that you are generating is 50,000. So, ROE is 50,000 return on an equity capital of 1 lakh, it is 50%. Debt capital will not be considered as equity capital. You need to understand this. Company still has only 1 lakh of equity capital. The other 1 lakh was through debt. So, it is generating 50,000, that is 50% return on equity capital of how much? 1 lakh. So, it is 50% return as compared to 30% return what it had if it had gone through option A, that is another 1 lakh of equity. So, you see, therefore, capital structure or debt equity mix cannot affect the total earnings of the firm, but it can have an effect on the share of earnings available to the equity share, because you see 60,000 was the total earnings in plan A, 60,000 was the total earnings in plan B. But when you see ROE, in plan A it was 30%, whereas in plan B it was 50%. So that's the difference. That is how the capital structure works in increasing the share of earnings for the equity shareholders. So we see ROE and we see EPS, which we will learn in the upcoming classes. These are the two matrices which will we see when we talking about the capital structure or the impact of leverage. What are the essential features of a sound capital structure? Maximum possible use of leverage. So what is leverage? Leverage we will understand in the upcoming slides, but I'll just give you a brief definition. So when you talk about leverage, or to be very specific, financial leverage, it is the use of long term fixed interest bearing securities along with the equity share capital to increase the earnings per share of the shareholders. This is the concept of leverage. When you are using more of debt, you are using more of leverage. So maximum possible use of leverage means the company should use as much as leverage as possible. But again, as much doesn't mean that you are compensating or taking too much of risk, because it will also bring an element of risk, because interest payment is a legal obligation, right? Capital structure should be flexible. By flexible, I mean it should be able to get capital whenever required, whichever capital it wants. Let's say company has too much of debt, 4:1 of equity ratio or 5:1 of equity ratio, and it gets any profitable projects, but it will not be able to get more debt at that point of time, because the lenders will be apprehensive in sanctioning debt, because companies already has a very high debt equity ratio. That is, capital structure should not be inflexible, it should be flexible. Avoid undue financial risk. Getting debt at a cheaper rate is good for the company, increases EPS, it increases ROE, but it also adds a lot of financial risk to the company. So company should avoid undue financial risk, because it might lead to the problem of bankruptcy, which can turn into liquidation as well. Minimum possible risk of loss of control. The company issues too much of equity shares, the control of the existing shareholders gets diluted, the EPS also will go down. So company should take this into consideration as well. Avoid undue restrictions in agreement of debt. If a company is using too much of debt in its capital structure, the financial institutions might impose certain restrictions on the company as far as the future debt is concerned. Let's say, what are these restrictions? Usually these restrictions are imposed on a financially weaker firm, and these restrictions are known as the loan covenants. What are loan covenants? Loan covenants can be the asset related covenants, where the financial institutions might put restrictions on selling of any of your let's say fixed assets, or it can be liability related covenants, where financial institutions might put restrictions on getting any additional liability, right? Or it can be, you can say, cash flow related covenants. It can put restrictions on the cash outflows, which might be related to purchase of any assets or payment of salaries to the permanent staff, so like that. Or there can be a control related covenant, which for this the financial institutions might appoint a nominee director on the board of directors of the company, so that to take care of the control of the company. So these are some additional restrictions that the financial institutions might use to safeguard themselves, because they have a feeling that the company might turn into problems of bankruptcy and liquidation, and in order to safeguard themselves they put these restrictions. So these restrictions should not be there if the company is avoiding too much of debt, right? Easy to understand and operate. Now sometimes what happens, a company might use multiple sources of securities for raising funds. They might be using equity, preference shares, money market instruments, bonds, debentures, bank loans. So sometimes evaluating risk and return of all the securities becomes a bit difficult, right? So it makes the capital structure a bit complicated. So company should use multiple sources, but it should not use too many sources of funds and make the capital structure more complicated. Minimize the cost of financing and maximize the earnings per share. So, when a company uses a mix of debt and equity and uses more of debt, company can reduce the overall cost of capital or weighted average cost of capital and can increase the earnings per share, right. Now, let us talk about the concept of financial distress and capital structure. So, what is financial distress? Financial distress comes into play when a company has taken a lot of debt, right. When a company is not able to make regular payment of interest and it struggles to make payment, there is a lapse in payment, the creditors might create pressure to the company, and that might create a situation of financial distress. If this is not solved, the company has to declare the state of bankruptcy, and even if it is not solved, it might turn into an event of liquidation. So, when a firm uses more and more of debt in its capital mix, the financial risk of the firm increases. It may not be able to pay the fixed interest to the suppliers of debt and may have to declare bankruptcy, that we already discussed, and the creditors may force the firm to liquidate, they may force the firm to sell their assets and get repaid. The bankruptcy costs include direct cost of litigation and the cost of managing a firm in liquidation. So, when a firm turns into a state of bankruptcy, so what happens is there are direct costs associated with litigation. Litigation means the company has to hire lawyers, they have to pay the fees to them, there are certain expenses related to court and all those things. So, this is the direct cost associated with litigation, and they have to also manage a business in the event of liquidation. So, these are the costs associated with the bankruptcy. A firm that is using more of equity may not have to face such bankruptcy costs because it may not pay dividends to shareholders in the absence of sufficient profits. The equity shareholders provides a sort of stability to a company, because unlike the you can say the debentures or the bonds or the loans, company is not legally obliged to make regular payment of dividends. If it has profits, it will pay dividends. If it is not making profits, it will not pay dividends. So, company is not legally obliged, right. So, it provides a sort of stability to the company. A sound capital mix has to take into consideration the benefits and cost of using debt. So, whenever you are planning a capital structure, it is true that debt has various advantages. It is cheaper, you get the advantage of tax leverage, which makes the cost of debt even more cheaper, but it also brings an element of risk. So, when planning a capital structure, you need to consider the benefits and the cost of using debt financing. Now, let us talk about companies and capital structures with some examples. Stable, mature companies, companies with predictable cash flows. What are predictable cash flows? Where you can, to an extent, with ease predict the cash inflows, cash outflows with ease or with more certainty, right, which are stable industries like utilities, electricity, natural gas. They can take more debt levels and can service their debt because the demand for their products is regular, the services that they are providing, that is regular, and there is not much fluctuations in demands and the earnings of the company. So, even in the lean years, if the market is not going through a good phase, they can actually service their debt. So, they can maintain a higher levels of debt, right. They are not cyclical industries, unlike hotels, unlike car industries, where there are a lot of booms and busts in the industry, or they face seasonal variations. This is not like that. So, they can take more debt and service their debt, right. High growth companies, companies with significant growth potential, so like tech startup, tend to have lower debt levels, giving them flexibility to raise capital quickly. So, there is a tech startup which has an enormous growth potential because they can get certain opportunities to make investment and grow substantially. But if they already have a lot of debt and any good opportunity comes their way, they might find it difficult to get additional debt. That is why they do not maintain a very high level of debt, so that in case they get a profitable avenue to make investment, they can get more debt and tap onto that opportunity. Companies in cyclical industries, what are cyclical industry? that varies, sometimes that has the seasonal variations. Sometimes there is a demand, the sales will go very high, and when there is no demand, the sales will go down, it will decline. Like hotels, during seasons, peak season, you'll see a lot of occupancy in the hotels, and during off seasons they are vacant, right? Companies and industries that experience booms and busts like hotels often maintain lower debt levels to weather economic downturns. If they take a lot of debt, so in lean seasons, in seasons when they are not making enough returns, enough earnings, it will be hard for them to make regular interest payments. So that is why they keep moderate levels of debt. So these are the books which you can go through to have a better understanding of the concepts that we have discussed in this unit, and thank you so much.